Hey, Real Estate Maxis. In today's episode, we're going to talk about how more houses is better because it reduces risk, believe it or not. Let's get started. Hey guys, welcome to Real Estate Maximalist. I'm your host, Alan Corey. I published 3 books in the personal finance, career, and real estate investing space. At one point, at a peak, I had 50 single family homes, which actually I sold as a bundle. I run a real estate brokerage team in Atlanta, operate a property management company, have over $50 million assets under management. I coach, consult, and teach real estate investing using the house fire method, but I find it easiest to just say, I'm a real estate maximalist. Last episode, we talked about house fire method, a house for every single bill, buy a house that spits off cash flow that pays for your debts. That's the house fire method, a house for every bill. Now, this requires buying multiple houses in most cases. Sure, you can have that one giant cash flowing property that's going to pay all your bills off. But that is not the way to think. Paying off one property is going to hold you back. It's going to hold you back in retirement. It's going to hold you back in living a more glamorous life. Actually, it puts more risk on your plate, having a paid off property, which I'll get into in a minute. But here's the thing. Once you buy one house and you see the power of that cash flow, it's going to get addicting. Because once you see that one property pays for one bill, and then you save up money, you buy another property that pays for another bill. And then you're like, wait a minute, it's faster to save up for that third house or that fourth house because my bills are already getting paid. So you can accumulate wealth so much faster because each house that you buy, your bills evaporate. Your bills get burned out by the house fire method. So all of a sudden, you don't have to worry about your internet bill. You don't have to worry about your phone bill. You don't have to worry about your utilities. You don't have to worry about your card payment. You don't have to worry about your debt. Imagine you're snowballing your real estate investment fund faster and faster and faster each year. It makes it much easier to buy real estate and accumulate real estate. And you're going to get addicted to that cash flow, which is a good thing. You want to be addicted to it. And a lot of people pause and they're like, I don't want to be a huge real estate mogul. You don't have to. Five properties, I promise you. Just make a commitment. I'm going to buy one a year for the next 5 years. I'll get you started in 10 weeks with my course. You'll have the tools to buy one every 10 weeks if you want to. But I understand that's not everyone's speed. But just make a commitment to yourself. You're going to buy one a year. And in 5 years, you can retire. It's that simple. It's that easy. Now, Real Estate Maxis, promise me one thing. If I convince you by the end of this podcast why buying multiple properties is better, then please leave me a review on Apple Podcasts, Spotify, or your podcast of choice. This is something I want to get this message out. I need your reviews. All I hear about is the algorithms love the reviews. So keep that in mind. If you learned something today, please leave me a review. I would greatly appreciate it. Now, here's a follow-up question I get quite often. Alan, I've got $100,000. I'm just going to buy a house in cash for $100,000. Yes, they exist. They're out there. They might not be in your hometown. I bought 30 homes in one day at an average price of $29,000 each, 1 hour from Atlanta, and they got an average $600 a month in rental income. I sold those 2 years later, an average price of $60,000 each. $100,000 homes exist, okay? Here's why you don't want to buy it in cash. This is also crucial in the house fire method. You put $100,000 in one house, it kicks off $1,000 of rental income. You could put $20,000 down on 5 different $100,000 houses, 20% down payments everywhere. And that cash flows the same amount of rental income as one house for you. And you're going to say that's risky. Why have leverage? Why have a mortgage if I can have one house fully paid off or 5 houses that have $20,000 down payment each and $80,000 mortgages each? Here's why. With one house, if you raise the lease every year, $50, you made an extra $600 a year. If you have 5 houses, you raise the lease $50, you have $3,000 extra dollars each year. Additionally, if you have a single house that's paid off and there's a vacancy, you have zero cash flow. You actually have negative cash flow because you're still paying property taxes and home insurance until that's filled. If you have 5 houses, one of them is vacant, which they probably, one will always be vacant at one time. depending on when you purchase them and tenant turnover, you still have 4 other homes that are going to pay for the mortgages of all 5 houses. The cash flow will be enough to cover them. So you'll never have a down month. It's like buying a mutual fund. Instead of putting all your eggs in one basket, you've got a collective that buoys your entire portfolio. So if you have one that's vacant or has a lot of repairs, the other ones who aren't getting as many repairs that month or that year are going to carry the other one. The houses may flip flop on what is the good one, what's the bad one, month to month or year to year. So you're actually reducing your risk by buying more homes. But here's the real wealth creator. We all know real estate markets go up and down. You're going to hold this as a long-term plan, 10 years, right? Any 10-year span in history, actually any 8-year span in history, as long as you've had real estate and you bought at the worst time possible, like at the peak of the crash of 2008, 2009, it took about 8 years for it to recover its value. And that was the worst housing crash we've ever had. There's now safeguards in place to not replicate that event again. And you're going to buy these properties for long term. This is your retirement plan. So you're going to hold them for 8 years. You're not looking to flip these. You're not looking to sell these. So let's assume over a 10-year period, just to make the math easy, homes appreciated 10%. If you had one paid off house, that $100,000 house with 10% appreciation, straight line, not compounded, you now have a $110,000 house. You put $100,000 in a property, and now you have $110,000 if you go to sell that property. Now, let's assume you bought 5 houses that are each $100,000. Fast forward until we have a 10% appreciation. Well, now you've got 5 homes that are $110,000 each. If you sold them all and paid off your mortgages, you would have $150,000. You've made 5 times the amount of money than you would have on just one. That is only in a home appreciation. We already know that you're going to make more money in cash flow because the rental income goes up. So all your wealth compounds the more properties you buy. This is the beauty of the house fire method. And this is why you can retire the fastest with this method and live the largest in retirement with this method. And it's incremental. You're keeping the money for yourself. Don't give it to the government to pay off your student loans. Don't give it to Elon Musk. Don't give it to Uncle Jeff Bezos. If you've got a $500 a month Amazon spending habit, stop giving it to Bezos. Go buy a house that cash flows $500 a month that goes to Bezos. Because if you have a house paying your Amazon bill or your Tesla car note, at least you're keeping the money for yourself. It's earning cash flow for you. It's appreciating along with the housing market. It stays attached to you because it's your asset that you own. And over time, there is a mortgage, and that tenant is paying down that mortgage for you. So let the tenants pay down 5 mortgages for you rather than no mortgages for you. Imagine a situation where you have tenants that are paying 10 mortgages, 20 mortgages, 30 mortgages for you. You're cash flowing on each one. Your risk is reduced with the addition of each property because it's the buoyancy method, your mutual fund of houses, and you're raising the rents $50 each year. How fast can you pay off your bills in that scenario? So that's why I challenge you. Why are you waiting? Are you waiting to time the market? You can buy a property now that cash flows. And I'm not saying now, as in when I'm recording this, I'm saying in any moment in history, you can go find a property that cash flows. You don't have a crystal ball. It's going to take you 10 weeks to go buy a house using my house fire method and the courses that I teach. So who knows what the market's going to be in 10 weeks? That's the thing. I don't care. I don't care if the interest rates are 20%, 30%, 3%. I don't care if the prices are up higher than they normally are or lower than they normally are. Because all I look at is this going to cash flow? I can lock in my mortgage. I can lock in a 12-month lease. And I know my cash flow is fixed for a year. At the end of that year, maybe I can refinance to a lower rate. That puts more cash flow in my pocket. But if the housing market crashes, that doesn't mean rental crashes. If you've ever had a landlord reach out to you that says, hey, the value of my home went from $500,000 to $400,000, so I'm going to reduce the rent I charge you from $4,000 to $3,500, call me. I want to talk to that landlord. That has never happened. No one reduces the rent that they charge you because the housing market fluctuates. Your rent's going to stay the same, or it's going to go up $50, $100, which is going to pay off more bills. House fire is going to burn your bills for you. This is a longevity, get rich slow method. I shouldn't even say that. It's get extremely wealthy slow, guaranteed with very low risk. That's the house fire method. Once all your bills are paid off, then you start making up expenses and you're going to say, I want a fancy new Tesla. Let me have a house that pays off that Tesla. I don't care if I have a $500 Amazon spending habit each month that I'm giving all my money to the richest guy in the world, Jeff Bezos. Let my house give money to Jeff Bezos. I'm going to keep my money in that house and the equity of that house. You're keeping your money that way and you're growing your money that way. And you're not compromising your lifestyle. You're increasing your lifestyle. All right, now I've saved the boring part. Towards the end here, I want to be talking about taxes. Let your eyes roll back in your head, but it's worth talking about. And I'll make this quick because I know taxes is not always the sexiest conversation. But if you hate wealthy people for not paying taxes, or if you want to be a wealthy person not paying taxes and have people hate you, you're going to want to pay attention. Now, here's the situation. You bought a cash flowing rental property. It's making you $500 a month. That's $6,000 a year. If you made an extra $6,000 a year at work, you got a raise, you worked overtime, you worked a side hustle, somehow you made an extra $6,000 a year, that's going to be taxed, federal, state. You're going to probably take somewhere between 35 to 50% of that. And you really just made about $3,000. Not in real estate, because of the tax benefits of real estate investing. There's something called mortgage interest deduction, which means, hey, I had to get a mortgage to buy this property, and that mortgage had interest. IRS says, hey, that interest is a business expense because you couldn't run this business of owning a rental property without getting a mortgage and paying that interest. So you get to write that off. So if I made $500 a month cash flow, but my interest on my mortgage payment was $500 a month, then guess what? On the books, it looks like I made $0. Therefore, I'm not taxed, even though I really made $500 cash flow. I still had the tenants paying down my principal balance on my mortgage, and they're already paying my interest on my mortgage. That's been worked in. So someone else is paying that, and I get credit for it as a business expense. There's also a second tax benefit. It's called depreciation write-offs. Now, depreciation is not the same thing or the opposite or even in the same realm as appreciation. Appreciation in real estate is the value of your home going up each year. Historically, about 3% a year. That compounded really, really increases the property value over time. Depreciation, not the opposite of that. Nothing to do with that. Depreciation is saying, hey, you started a business that had a bunch of equipment, and that equipment was buying a house that includes the equipment of the siding, the roof, the plumbing, the electrical panels, all that, right? If you were to start a business and you had to build it from scratch or buy a warehouse or a factory, all that is business expenses. So IRS is saying, wow, buying a house, this small business that you're creating is also a business expense. And you can use this whether it's in your personal name or an LLC. So don't take this and run with it that you have to have an LLC to get this. If it's in your personal name, you still get these benefits. You can run a business under your personal name. And what they're saying is, hey, let's say you bought a house for $100,000. If it's a residential property, 4 units or fewer, they're going to say all that equipment will probably have to be replaced over a span of 27 and a half years. So we're going to take that $100,000 house and we're going to take off about 20%. Let's just say $20,000 is the land value. So even if the house crumbles, you still have land. So you can't depreciate the land, but you can depreciate everything that goes above it to make it a business, to make it a place that you can rent out to someone else. So you've got $80,000 and they say that will all have to be replaced over a span of 27 and a half years. You probably have to replace the roof at one point in 27 and a half years. Maybe the siding, maybe fresh paint, maybe electric, maybe the plumbing, right? Your business cost $80,000 when you purchased it. 1/27th of that is $2,909 a year. They're just going to give it to you. You have to take it. You can't not take it. It's just automatically included. So that means if I was making $500 a month cash flow, that's $6,000 a year. I get to take off $2,909 each year as an expense in my business that offsets that cash flow, which then says, hey, I really made $3,100. And then I'm taxed on that smaller amount rather than that larger amount. But this depreciation coupled with the interest deduction tax will most likely always cover the cash flow that property is making. So on the tax returns, even though I really am pocketing money, it appears on my taxes as if I'm not making money, that either I'm breaking even or I'm losing money. And so the IRS can't tax you. They only tax you when you make money. So again, the more properties you have, the more depreciation you can claim on these properties. And the more mortgages you have, the more interest deduction you can claim. So regardless of how much cash flow you have, you can kind of shuffle around your properties or continue buying properties one a year to cover all your cash flow and take all this depreciation. Because an advanced strategy is something called cost segregation studies and bonus depreciation. These are other advanced tax loopholes that you don't even need to understand. Don't worry about it. Let your accountant worry about it. Your CPA is paid to understand these things. And what it's saying is, hey, I bought a property, and rather than taking $2,909 every single year, let me take $30,000 the first year in deductions. And I'll just take fewer deductions later on because I'm going to replace the roof now and the siding now. And I'm not going to spread out these expenses over the next 27 and a half years. I'm going to do those renovations or those fixes now. And I'm going to front load that depreciation in year one or year two. So I know investors who have income from their cash flowing assets and they just buy one property a year for the sole reason that they can front load this depreciation to offset their cash flow. So always in the books, it looks like they're breaking even or losing money. This is not illegal. This is not a loophole. This is just the IRS rules for real estate investors. That is why wealthy people avoid taxes. That is how you're going to avoid taxes or greatly reduce your taxes. And you get more and more benefits the more and more properties that you purchase. So hope I didn't lose you. Hope I didn't bore you talking about taxes, but hopefully I widen your eyes seeing the benefits of owning multiple properties and trying to acquire them every single year. It's just a windfall for your finances. So there's your quick rundown of why more houses is better, why not paying off your mortgage is better, and why you are going to leave me a wonderful review on Spotify or Apple Podcasts or wherever you listen to podcasts, because I can't argue with what I just laid out there. It's mathematically going to help you. And if you still feel like, wow, this feels risky having 5 mortgages, 5 houses, here's the thing. You could let 2 of those go in foreclosure and burn to the ground. And you just ignore them and put your head in the sand for whatever reason. You're still going to have more money with the 3 other ones that you're paying attention to that are working out well for you than you would with just having one house that was paid off. All right, guys, if you learned anything, please tell a friend about this podcast. Please sign up for my newsletter at realestatemmaxi.com or join the Real Estate Maximalist Facebook group. It's been a pleasure. Thanks for listening. I'm your host, Alan Corey, and this is Real Estate Maximalist.